Let's now look at some conceptual side of stocks. Going back to income statements, let's say we have an income statement for some year where we start with the sales revenue, subtract cost of goods sold and depreciation, which leaves us with earnings before interest and taxes, EBIT. Then we pay interest, that leaves us with taxable income that we have to pay taxes on. We pay taxes at some tax rate, let's say it's 34% or maybe something else, and that leaves us with net income or profit for the year. And that profit for the year is then used by the firm to pay out dividends. Whatever may be kept by the firm is known as retained earnings for that specific year. So in the middle of this income statement, we have interest paid. That's coupon payments paid on corporate bonds, as well as any interest paid on any bank loans. So bond holders are the first group of investors who receive money from the company's annual revenues. Then go the stockholders. Preferred stockholders get the first priority in receiving dividends. Common stockholders get the last priority. So we have bondholders, preferred stockholders, and then common stockholders who receive the money from the corporate revenues every year. Let's look at common stock. Common stockholders have certain rights. Let's list just a couple important ones. They can participate in electing the directors, who then hire managers to run the company. Common stockholders do not directly run the company, but they can hire people who will do that for them. They can participate in electing people who will be then running the company. Common stockholders have rights called subscription rights. This means that when the company sells shares of stock, in addition to what it issued, in the past, then the existing stockholders may get this right to buy the newly issued shares of stock before those are offered to the general public. And typically this happens at a discount. Proxy voting is when you use your authority to vote and give it to somebody else. And typically all shares have equally weighted votes. So one share equals one vote. However, some companies have different classes of stock. Some companies have more than one class of stock. For example, Google has Class A, Class B, Class C stocks. Class A are held by the public. These are sort of the most common class, where each share of stock allows to give one vote. Class B are those shares of stock that are held by the company sort of managers, and they play a much bigger role in voting for different decisions that need to be made. So one stock in Class B is worth 10 votes. And then the last thing is dividends. So when dividends are announced by the company, so let's say the company announces that in 4 weeks we are gonna pay a $1 dividend on each share. Once that announcement is made, it becomes a liability to the company. Then when you as an investor receive your dividends, because that's your extra income, you're required to pay taxes on that. So the tax rate, is 15%. However, do you have to pay taxes on any price appreciation of your shares? No. You're only paying taxes on capital gains when those are realized. In other words, when you're actually selling your shares. So at that time, when you're selling your shares, and if you're selling them for more money than how much you paid to buy them in the past, then that difference or the capital gain is going to be taxed. So in a way, you can choose when you pay taxes on your capital gains, but you cannot choose when you pay taxes on your dividends. Now, a few details about preferred stock. So they're called preferred because dividends on preferred stock shares are paid out first before the dividends on common stock shares are paid out. What does a phrase like a 5% preferred stock mean? It doesn't mean that 5% is the return on preferred stock. It means something else. You take 5% that's given as part of such phrase, you multiply it by so-called stated value, which is usually $100, and you get $5. So $5 is the dividend on preferred stock, which will be, repeating over and over and over again, right? So a 5% preferred stock means the dividend is $5 per year. A 7% preferred stock would mean that the dividend is $7 per year. So a phrase like this gives you the information about the dividend amount, not the return on preferred stock. Next, cumulative versus non-cumulative dividends. Let's say it was a bad year for the company, it didn't make much profit. Can it just skip making dividend payments to the preferred stockholders? Yes, it can skip. Does it have to, pay extra, after a while when it does have money? Yes, if it's so-called a cumulative dividend preferred stock. So if the dividend is not paid this year, it will be carried over to the next. And they will be carried over until the company has enough money. So maybe 2 unpaid dividends are carried over to the third year. And then in that third year, the company will pay 3 years worth of dividends to make up for the previous 2 years of unpaid dividends. However, the company does not have to pay any dividend to make up for the years when it was not paid if it's a so-called non-cumulative type preferred stock. So if not paid this year, the dividend is not carried over to the next year. Obviously, these kind of shares, the non-cumulative type of shares, will be cheaper, right? And the cumulative shares will cost investors more money because that's really where your dividend will be guaranteed to you. And then another kind of sort of open-ended question regarding preferred stock. Is it debt or is it equity? Because it's equity due to the fact that the dividends on preferred stock are paid out of net income, but in a way it behaves like debt because the company is required to make dividend payments, especially if it's the so-called cumulative type preferred stock. So there's kind of a lot of discussion whether preferred stock is equity or is it debt or maybe some sort of hybrid form of both.